Hello everyone, and I need you to hear this clearly. What you've observed in silver so far isn't the movement. It's the market stretching its legs before the sprint. The genuine breakout, the one that rewrites portfolios and humiliates the headlines, hasn't even manifested yet. And if you blink, you'll overlook the quiet clues that are already stacking up right in front of us. Some of you clicked because you desire price targets. Some of you clicked because you experienced the economy becoming weird. And some of you clicked because you're exhausted of being informed everything is fine while your grocery bill informs a different narrative. Good, because today we're going to connect the dots the way most people refuse to. We'll discuss why silver still appears like one of the most underpriced, most politically inconvenient assets on the planet. We'll discuss why the debt market is the genuine puppet master behind almost every surprise movement you perceive. And we'll discuss the shift occurring under your feet, where currency becomes more digital, more programmable, and more governed, while hard assets quietly become more valuable. Now listen, quick favor, and I'll obtain right into it. I'm running a campaign to wipe out copycat channels that recycle other people's labor, and the only way it functions is if the genuine community manifests. If you value what I execute here, hit subscribe and drop a short comment. Literally type WFH, so the algorithm understands you're with me. And while you're here, I desire you to understand this. My analytics demonstrate a huge percentage of viewers observe the full videos but never subscribe. If you're one of them, fix that today. It costs you nothing, but it maintains this channel alive. Okay, one more tool that assists you daily. I've generated a WhatsApp channel where I drop rapid updates, short posts, and personal analysis that I don't position on YouTube, plus instant voice notes when something fractures suddenly. If you desire daily videos, quick alerts, and those premium community updates, the link is in the description. Join it now so you're not late when the market shifts while you're asleep. All right, let's establish the stage with something practical. Because I understand some of you desire options, not merely substantial ideas. If you're constructing a physical position, you've probably noticed premiums possess a personality. One week it's composed, the next week it's chaos. This week, the market has been presenting familiar selections. Small fractional gold coins priced at a tight premium over melt. Brand new 1-ounce silver coins priced at a fixed amount over spot, and old US 90% half dollars priced by the ounce. I'm not providing phone numbers here, and I'm not informing you purchase this exact thing. I'm informing you what matters. Observe premiums, observe availability, and observe how rapidly product disappears, because scarcity manifests in the genuine world before it manifests in a chart. Now here's the core idea that transforms everything. Most people discuss silver like it's a normal commodity that elevates when inflation elevates and declines when rates elevate. That's the kindergarten version. Silver isn't merely a metal. Silver is a stress indicator. It's a report card on confidence. It's a loud, shiny critique of paper systems. And that's why it's been pushed down, discussed down, and transformed into a punchline for decades. Because if silver ever trades like a truthful asset, it doesn't merely hurt traders, it embarrasses institutions. It reminds normal people that the perfect system is constructed on claims, not on reality. So I spent time this week reviewing the arguments from a veteran market observer, someone who's tracked leverage cycles, debt dynamics, and currency conduct through multiple regimes. And the communication wasn't cute, it was blunt. We've barely scratched the surface. Not tomorrow it moons, not next week it's over. Just a composed reminder that what you're perceiving right now appears like the early tremor, not the earthquake. Here's why. The genuine driver isn't a headline. The genuine driver is the debt market. Because the debt market is where the entire system either survives or fractures. Stocks can be floated, narratives can be manufactured, statistics can be massaged. But the debt market? That thing is a monster. And when it transforms, it drags everything behind it like a chain. Let me simplify the engine in one sentence. The modern system survives by expanding debt and suppressing the cost of debt. That's it. That's the trick. When currency is cheap, everything appears healthy. Companies refinance. Governments roll obligations forward. Consumers borrow. Asset prices inflate. And the public experiences wealthier because charts elevate. But cheap currency possesses a side effect. It consumes buying power. It quietly punishes savers. And it generates a world where the only way to maintain up is to accept more risk. So what occurs when the engine initiates coughing? What occurs when the cost of currency elevates, or when purchasers of debt step away, or when a refinancing wave hits at the incorrect time? That's when solutions obtain ugly. And when solutions obtain ugly, silver ceases being an investment and initiates being a lifeboat. Now I desire to discuss something that sounds small but isn't. The mental shift. I speak to intelligent people constantly, educated, hardworking, responsible. And when they purchase their first precious metal, they experience weird. They experience like they're executing something risky, like they're sneaking out of class. That is conditioning. For decades, people were trained to believe a number on a screen is safer than something you can maintain. They were trained to believe safety means permission. Permission from banks, permission from apps, permission from policies. And the first time you step outside that narrative, your body reacts. Your brain states, this is unfamiliar, so it must be hazardous. But here's the twist. Unfamiliar doesn't mean unsafe. Unfamiliar merely means you weren't instructed it. That's why the first purchase is always the most difficult, because you're not combating mathematics. You're combating a mental cage. You were instructed to trust guarantees. You were instructed to trust accounts. You were instructed to trust statements. But an account is a claim, not a possession. A statement is a narrative, not an asset. When the system is composed, that distinction experiences academic. When the system fractures, that distinction becomes everything. And this is where people question me the identical question in 100 ways. Should I await a pullback? I obtain it. Everyone desires to be the genius who purchases the exact bottom. But here's the honest answer. Most people who await the perfect entry don't conclude with more metal. They conclude with more excuses. They spend months observing, refreshing, hesitating. And then when the movement occurs, they panic purchase higher, or they freeze again and overlook it entirely. So what's the genuine risk? Is the risk that silver wiggles down for a week? Or is the risk that you spend the next 2 years awaiting a perfect price while the world shifts from a paper trust era into a hard asset era? Volatility is annoying. Delay is lethal. Now let's address the most substantial trap, the mainstream narrative machine. Whenever metals obtain interesting, the financial media suddenly discovers a reason why you should not purchase. It's always something technical sounding. It's always something temporary. It's always something that makes you experience like you're late or foolish or reckless. One week it's too much supply. Next week it's a strong dollar. Next week it's higher rates. Next week it's ETF flows. Next week it's positioning. Next week it's seasonality. And if you pursue every explanation, you'll never act. Because the objective isn't to inform you. The objective is to maintain you in the herd. And the reason they don't desire regular people possessing physical should be evident. Every unit of currency you convert into metal is a unit they can't easily funnel back into fees, products, and command systems. Physical is annoying to an industry constructed on intermediaries. Now, I'm not stating every journalist is malicious. I'm stating the incentives are what they are. If your enterprise is liquidating paper products and maintaining people in the system, you're not going to encourage people to exit the system into something they can maintain privately. So yes, you'll perceive expert narratives warning about massive liquidating pressure or technical headwinds or rebalancing occurrences or rollovers. And some of those things cause short-term commotion. But the larger question is this. Does short-term commotion transform the long-term mathematics? No, because long-term mathematics is about debt levels, currency dilution, and trust. Now let's connect dots that most people disregard. The world has been trained to believe the currency is stable because it possesses a flag on it. But currency stability originates from buying power. It originates from discipline. It originates from balance sheets that make sense. And it originates from people believing tomorrow won't be worse than today. And when those ingredients diminish, the public doesn't notice initially. They adapt quietly. They cut corners. They trade down. They postpone plans. They accept less. Then one day they notice the truth, all simultaneously. And that's when trust fractures rapidly. That is the instant silver is awaiting. Now I desire to obtain specific without transforming this into a textbook. If you desire to track whether the pressure is constructing, cease observing only price. Observe conduct. Observe how rapidly coin inventory disappears after a dip. Observe whether backorder becomes a normal phrase again. Observe whether delivery delays initiate manifesting in locations you didn't expect. Observe whether the futures curve initiates executing strange things, like compensating you more to delay delivery, or sometimes even compensating you less because the market desires metal now. Observe whether borrowing expenses and share lending around silver-linked products spike. You don't need to be a wizard. You merely need to notice when the system obtains nervous, because nervous systems leak information. And here's a cliffhanger most people won't anticipate. The next substantial silver movement may not initiate with silver whatsoever. It may initiate with the bond market refusing to conduct itself. It may initiate with yields fracturing ranges that policymakers can't tolerate. It may initiate with a sudden pivot where the public is informed one thing in the morning and the opposite thing at night. It may initiate with a liquidity occurrence that obtains described as temporary. And, in those instances, silver doesn't request permission. It reprices. This is why I maintain stating, observe the debt market. The debt market is the lever, and whoever commands the lever commands the narrative until the lever snaps. Now, let me inform you a quick narrative that illustrates the paralysis problem. A while back, someone I understand possessed extra cash sitting around. Not huge currency, but meaningful. And at the time, silver was cheap enough that you could construct a genuine position without experiencing like you needed a second job. I suggested purchasing a little at a time. He didn't, not because he lacked intelligence, but because he lacked permission. He desired a perfect confirmation. He desired the news to state it was safe. He desired the market to clap. Then the price shifted, and suddenly he was interested. But now he was worried he was late. Then it shifted again, and now he was awaiting a pullback. That's the loop. And the loop exists to maintain you from possessing genuine things until they are expensive. Now I desire you to comprehend something that might sound harsh, but rescues people. You can be correct and still overlook the benefit if you can't act. So the strategy isn't to forecast the future. The strategy is construct a position that survives multiple futures. Now another part of this conversation is uncomfortable. What would it require to genuinely restore buying power? In theory, you could defend a currency by making currency expensive, elevating rates difficult, permitting poor debt to fail, compelling discipline back into the system. But in practice, that's politically painful. It causes defaults. It causes unemployment spikes. It causes asset price declines. It causes anger. And if you exist in a world where institutions are addicted to composed and charts, they avoid pain as long as possible. So instead of discipline, you obtain delay. Instead of difficult truth, you obtain soft language. Instead of we're over-leveraged, you obtain we're navigating headwinds. Instead of we printed excessively much, you obtain we ensured stability. Instead of we're devaluing, you obtain we're supporting expansion. This is why I inform you. The debate isn't about favorable intentions. It's about incentives. And incentives point toward more borrowing, more dilution, and more management of perception. Now let's discuss the trajectory that ties it all together. The movement toward tokenization. You don't need to love technology to comprehend this. The financial system loves anything that increases visibility and command. It loves anything that decreases friction for institutions while increasing friction for individuals. Tokenization, digitizing assets, deposits, settlement systems, generates a world where currency becomes programmable. Programmable currency can be nudged. It can be limited. It can be routed. It can be monitored. It can be frozen. It can be adjusted under the correct circumstances. Again, I'm not stating that's occurring to you tomorrow. I'm stating that's the trajectory, and that trajectory transforms your risk profile. In a world where more prosperity is trapped inside permissioned rails, possessing some prosperity outside the rails becomes rational. That's why hard assets matter, even if you never plan to liquidate them. They're not only about profit, they're about optionality. Now I'm going to state something that might obtain clipped out of context, but it's genuine. People are being trained to accept less freedom in exchange for a sensation of safety. That trait is ancient, and it functions finest when people are strained. So observe the strain. When strain elevates, people plead for solutions. When people plead, solutions materialize, pre-constructed, pre-packaged, and conveniently designed for command. That's not conspiracy. That's pattern recognition. Now let's bring it back to silver and to your day-to-day selections. If you're new, the most substantial error is attempting to execute everything simultaneously. Don't. Initiate with education. Learn how spot price relates to what you actually compensate. Learn why premiums transform. Learn what liquidity resembles in your area. Learn how you would liquidate if you needed to. Learn storage options that fit your existence. Then construct gradually. If you're experienced, the most substantial error is permitting tedium to make you sloppy. Don't. Tedium makes people pursue shiny objects. It makes people overtrade. It makes people abandon favorable positions for something exciting. The market punishes that. Now, quick creative detour for my silver people, because some of you need motivation, not more charts. If you love hearing genuine narratives of how ordinary individuals transformed intelligent determinations into substantial victories, there's another channel I recommend, and the link is in the description. Go subscribe over there too, because those achievement narratives hit different when you're attempting to remain patient through the tedious aspects. Okay, back to the deeper thread. One of the most revealing signals right now is lifestyle downgrading spreading upward. It's not only low-income households experiencing it. You're perceiving people with robust salaries quietly trading down. Cheaper shopping, fewer upgrades, delayed plans, maybe next year conversations. That's not merely personal budgeting. That's macro strain manifesting at the street level. And macro strain possesses consequences. Macro strain makes voters angry. Macro strain makes policymakers reactive. Reactive policymakers execute what? They stabilize first and explain later. And stabilization frequently means more liquidity, more support, more interventions, more dilution. And that dilution is precisely what hard assets respond to. Now I desire to pull you in with an if-then chain, because this is the type of logic that maintains you composed. If debt levels are excessively elevated to tolerate elevated rates, then policymakers will avoid sustained elevated rates. If policymakers avoid sustained elevated rates, then currency strength becomes more difficult to maintain. If currency strength becomes more difficult to maintain, then buying power maintains leaking. If buying power maintains leaking, then scarce assets elevate in that measuring unit. And if scarce assets elevate while the public is still distracted, the early movers succeed. That's it. Now let's address another piece people misunderstand: paper exposure. There are products that claim silver exposure. Some are useful for traders, some are convenient for liquidity, but none of them are identical to physical in your possession. A paper claim can be diluted, a paper claim can be cash settled, a paper claim can be gated, a paper claim can be restricted. Physical is straightforward. It exists or it doesn't. And I understand some of you will state, but I can profit from paper. Sure, some people can, but most people aren't full-time traders. Most people don't possess time to babysit positions. Most people desire an insurance layer, not a constant adrenaline task. That's why I maintain coming back to the identical principle. Don't construct your long-term security on someone else's guarantee. Now this is where the retention obtains genuine, so remain with me. There's an instance in every cycle where the public is provided a selection without being informed it's a selection. They're presented convenience at the expense of autonomy. They're presented guarantees at the expense of adaptability. They're presented security at the expense of privacy. And many people accept because they're exhausted. But the people who aren't exhausted because they prepared can select differently. That's why preparation isn't paranoia. Preparation is energy management. Now I desire to discuss the wealth transfer nobody desires to admit. When currency loses buying power, people who depend on wages and cash savings obtain squeezed. People who possess scarce assets and possess access to leverage obtain wealthier. It's not moral. It's not fair. It's not a debate. It's a description. So what do you execute if you're not in the Access Club? You cease pretending the principles are different. You adapt. You construct genuine assets. You decrease fragile debt. You develop multiple income streams. You cease existing like the measuring unit will protect you. Now I'm going to add a viewer question segment because you question these constantly and it maintains us grounded. Question 1. If silver is so undervalued, why hasn't it exploded already? Because undervalued can last longer than your patience. Because suppression is genuine, but suppression also needs stability. Because the market is small, and small markets can be pushed around until the pushing becomes excessively expensive. And because psychology matters. When the crowd doesn't care, movements are slower. But when the crowd suddenly cares, movements become violent. Question 2. How do I understand when things are transforming? Observe the conduct, not the slogans. Observe if dips obtain purchased instantly. Observe if premium spikes occur without price spikes. Observe if delivery timelines extend. Observe if shortages become normalized. Observe if the tone of the media shifts from nobody desires it to it's hazardous to it's excessively late. Those tone shifts are tells. Now I desire you to participate because your response actually shapes the next videos. Do you reason silver is late because the price already elevated a bit? Or do you reason it's early because the system that leans on it is becoming louder and more desperate? Drop your take in the comments. And here's another question. If silver jumped 20% in a week, would you experience proud because you're positioned or strained because you're not? Be honest. The honesty is the initiation of favorable strategy. Now I also desire to execute something that constructs community, not merely views. If you've possessed a victory, any victory, share it in the comments sometimes. Did you compensate off debt? Did you initiate a side hustle? Did you purchase your first ounce? Did you hit a milestone? Share it. Not to flex, but to lift others. A substantial amount of people observing are silently anxious, and genuine achievement narratives from regular viewers execute more for morale than any chart ever will. Now, let's discuss a term that frightens people: reset. People imagine a reset is one dramatic day where everything shuts down and sirens go off. Sometimes it's dramatic, frequently it's not. Frequently it's a slow sequence of policy adjustments, new settlement principles, new reporting standards, new digital rails, and new features that slowly transform what currency is. That's why you don't await a crash to prepare. You prepare for a drift because drift is what fractures people. Drift is what makes them numb. And numb people accept anything. Now, a practical checklist because I don't desire to leave you with only philosophy. If you're constructing a position, consider executing 3 things. 1. Determine your purpose. Are you purchasing for protection, upside, or both? 2. Select a straightforward mix. Don't overcomplicate. Standard items are standard for a reason. 3. Construct consistency. Small regular purchases defeat substantial emotional purchases. And if you already possess a position, consider 2 things. 1. Don't permit a small pullback to shake you out. 2. Don't permit a small rally to make you reckless. Discipline succeeds. Now I desire to bring back the debt market one more time, because this is the aspect that will determine the pace. There's a reason veteran operators observe yields like hawks, because yields are the price of trust. When yields elevate sharply, it means lenders demand more compensation to maintain the debt. When lenders demand more compensation, the borrower experiences pain. And when the borrower is massive, governments, corporations, systems, the pain becomes a policy problem. Policy problems obtain solutions, and those solutions are seldom friendly to buying power. So if you perceive yields acting volatile, don't merely treat it as a chart. Treat it as a warning light. Now let's insert a cliffhanger that matters for retention, because this is where people obtain caught. The first phase of the movement frequently appears like a fake out. Silver pops, then declines. Silver runs, then stalls. Silver makes people doubt. That's not an accident. That's how markets shake weak hands and invite late purchasers at worse prices. So if you perceive volatility, don't assume it means game over. Sometimes volatility is the invitation. Now, quick reminder, because I guaranteed you, and it's significant. By the time you're observing this, the members-only video should already be live. If you desire one single video that bundles the latest updates with deeper analysis and connects the dots without the public-friendly censorship, join the membership. Premium members obtain more in-depth breakdowns. And honestly, it also informs me who's genuinely following this labor beyond casual observing. And yes, if you join, you'll also perceive the timeline board I maintain, updated where I map out what signals I'm observing and what would make me transform my stance. Before I permit you to go, I desire to walk you through a few myths that maintain people trapped, because these myths are precisely how the crowd obtains harvested. Myth 1. Silver is only an industrial metal, so it can't be currency. Wrong framing. Silver can be industrial and monetary simultaneously. In fact, that dual personality is part of why it's so explosive when circumstances shift. Industrial demand provides it a constant heartbeat. Monetary demand provides it sudden surges. When both collide, price doesn't tiptoe. Myth 2. If silver was significant, the substantial institutions would inform us. Examine around. Institutions don't instruct you how to leave them. They instruct you how to utilize them more efficiently. If the product is remaining inside the system, the marketing will always point you back inside the system. Myth 3. I'll purchase when it confirms. That's the most expensive sentence in investing. Confirmation typically materializes at a higher price, a tighter supply, and a louder crowd. By the time you experience safe, you're frequently late. Now here's a straightforward way to reason about silver without requiring a PhD. Silver is a tiny market compared to global currency. That matters because when a tiny market encounters a substantial flow, it doesn't shift politely. It gaps, it overshoots, it revalues. And the flows don't need to be huge. They merely need to be persistent. If even a small slice of investors determine they desire a genuine asset layer, silver is one of the first locations it manifests, because there isn't a bottomless warehouse of extra metal awaiting to satisfy sudden demand at current prices. And that brings us to the aspect nobody appreciates to discuss about, the ratio narrative. People love to argue about the gold to silver ratio like it's a magic principle. It's not a principle, it's a relationship. And relationships transform when the environment transforms. In stable times, the ratio can remain wide because paper systems experience reliable. In strained times, the ratio can compress because silver's smaller size makes it more sensitive to shifts in monetary demand. You don't need a precise terminal ratio to benefit. You need to recognize the trajectory of pressure when confidence transforms. Now let's obtain even more practical. If you're brand new, here are the 3 errors I desire you to avoid because they generate regret. Mistake 1, purchasing only the most exotic items because you reason rare equals superior. For most people, standard is superior. Standard means liquidity. Standard means easier pricing. Standard means less confusion. Mistake 2, awaiting the perfect price and then attempting to purchase everything simultaneously when the movement already initiated. That's how people overpay and panic. Mistake 3, purchasing without a storage plan. You don't need a vault movie. You merely need a plan that matches your living situation and your risk tolerance. Now, if you're experienced, here are 3 different errors that manifest at the next level. Mistake 1, forgetting why you purchased. If your objective was protection and optionality, don't suddenly treat your stack like a day trade because you obtained board. Mistake 2, obtaining emotionally attached to a number. People become obsessed with it must hit X. That's hazardous because markets seldom deliver in the way people fantasize. Concentrate on the progression, not the prophecy. Mistake 3, disregarding the rest of your existence. A stack isn't a substitute for health, abilities, and relationships. Silver is a tool, not a religion. Now, let me share a framework that maintains me grounded when the internet obtains loud. I split the world into 3 layers. Layer 1 is survival. Food, shelter, health, emergency cash, basic resilience. Layer 2 is stability. Decreasing toxic debt, constructing income, protecting buying power. Layer 3 is opportunity. Assets that can multiply if the system revalues. Metals, productive assets, abilities that compensate. Silver sits between layer 2 and layer 3. It protects buying power and it carries upside if the monetary demand wave hits. And that wave can hit faster than people expect, because confidence doesn't deteriorate in a direct line. It deteriorates quietly and then suddenly. Now, here's a retention punch you need to hear. A substantial amount of people assume the next crisis will resemble the last crisis. It won't. The last crisis trained people to expect bailouts and instant rebounds. That training is hazardous because it makes people complacent. The next strain occurrence could be more fragmented. It could be a series of smaller shocks that never completely resolve. It could be volatility that lasts longer than the public's patience. It could be policy whiplash. And policy whiplash is rocket fuel for hard assets because it destroys confidence in planning. If you can't plan, you hedge. If you hedge, you purchase scarcity. If you purchase scarcity, prices revalue. Now, some of you are reasoning, okay, John, but what's the trigger? Here's the honest answer. Triggers are typically evident only in retrospect, but we can discuss circumstances. Condition 1, the bond market initiates signaling that trust is wobbling. You'll perceive it in stubborn yields, failed auctions, or sudden spikes that are explained away as technical. Condition 2, policymakers initiate speaking in contradictions. One day it's inflation is gone. Next day it's inflation is sticky. Next day it's we're cutting. Next day it's we're pausing. When the communication becomes a blur, the public senses it. Condition 3, the genuine economy demonstrates strain while asset prices still float. That mismatch generates anger and political pressure. And political pressure generates policy errors. Condition 4, physical tightness manifests in the retail pipeline. If people can't obtain what they desire easily, they compensate up. If they compensate up, others notice. If others notice, the crowd materializes. Now I desire to underline something that obtains disregarded. Crowd conduct is nonlinear. Most people execute nothing until the movement is evident, and they all shift simultaneously. That's why you obtain the weird phenomenon, where supply experiences fine for months, and then suddenly overnight, everyone is questioning the identical question. Where do I purchase? And by then, the premiums are higher, the selections are fewer, and the wait times are longer. That's the late fee I maintain discussing. Now I'm going to bring you into an instance of uncomfortable honesty. If you're observing this, and you possess zero exposure, your most substantial adversary isn't the market. It's the inner voice that states, I'll execute it later. Later is how people obtain trapped. Later is how people wake up at the worst time. Later is how people conclude purchasing under pressure. So here's a gentle but firm challenge. Accept one small behavior this week. It could be research. It could be a first tiny purchase. It could be organizing your finances. It could be joining the WhatsApp channel so you remain connected. Small behaviors compound. Now let's discuss why I don't obsess over short-term predictions. Short-term predictions make favorable clips. They don't construct positions. Pressure construction is visible in the way markets are maintained afloat with narratives. And pressure construction is visible in the gap between what people are informed and what they experience. Now I desire to address something that might be on your mind. Isn't all of this excessively negative? No, this is realistic. And realism is empowering because once you accept the incentives, you cease wasting energy arguing with reality. You cease awaiting fairness. You cease pleading for permission. You construct your plan. You execute composedly. You protect your people. Now I'm going to add another cliffhanger, and I mean it. In the next stretch, the narrative will probably flip again. You'll perceive a wave of commentary calling silver overheated if it runs. Then you'll perceive a wave calling it broken if it consolidates. Then you'll perceive a wave calling it hazardous if it threatens to fracture out again. That emotional roller coaster is designed to make you trade your position for doubt. Don't. If you constructed your position with purpose, permit it to execute its task. Now, one more thing. Because it matters and it's frequently disregarded. Community is an asset. Most people attempt to execute everything isolated. They remain quiet. They conceal their worries. They isolate. But when you share knowledge, you decrease fear. When you decrease fear, you make superior determinations. So if you've acquired something from this channel, don't maintain it to yourself. Share it with someone who's open-minded. And if you're accomplished, share your achievement in the comments. Sometimes even one sentence can transform someone's day. Now let's discuss discipline in one last practical way. A disciplined purchaser executes three things. They purchase with a plan. They don't pursue with emotion. They don't liquidate based on headlines. A disciplined viewer executes three things too. They subscribe so they don't overlook updates. They engage so the algorithm pushes the content to more genuine people. They join the WhatsApp channel so they obtain rapid signals when the market shifts unexpectedly. Now, if you've remained with me this long, you're not a casual viewer, you're a serious one. And that's why I desire you to maintain onto this final idea. The most substantial silver movement typically occurs when the most people still believe it can't occur. That's the instance the system is compelled to admit strain. That's the instance the crowd flips. That's the instance the late fee manifests. And that's why I maintain stating, we're early. not because of a date, but because of positioning, narrative, and conduct. One last thing I'm observing, and it's straightforward. How rapidly the market forgives poor news. When silver shrugs off frightening headlines, that's strength. When dips obtain purchased without drama, that's strength. When premium remains stubborn even after price pauses, that's strength. And when the debt market initiates acting like it desires higher compensation, that's the warning bell that compels the whole system to react. Over the next few days, listen for a tone shift. Silver is a distraction. Then, silver is risky. Then, silver is excessively late. That sequence is how the herd is directed. If you notice it, you're ahead. Drop a quick comment informing me which one you're hearing most, and I'll tailor the next breakdown around it. Also, observe what your local dealer executes. If they maintain premiums elevated and restock slowly, that's the genuine vote. Paper can lie. Inventory can't, the way charts sometimes can. Now, I'm going to close with a communication that's both practical and a little aggressive, because the instance demands it. If you're still existing as if the measuring unit will protect you, you're existing in a fairy tale. If you're still awaiting permission from headlines, you're already behind. If you're still confusing access with ownership, you're gambling with your future. So here's what I desire you to execute today. First, subscribe, because this channel only expands if genuine viewers cease being silent. Second, join the WhatsApp channel in the description for instant updates and voice notes. Third, check the members-only video that's already live if you desire the full connected picture. Fourth, comment WFH if you support the campaign against copycats and desire this channel to maintain expanding without obtaining buried by recycled content. And if you obtained value today, share this with one person who maintains stating, "I'll examine it later," because later is where most people lose. Silver's movement hasn't even initiated, and when it executes, the people who prepared quietly will appear like geniuses, while the people who awaited confirmation will compensate the late fee in the form of higher prices, tighter supply, and regret. I'll perceive you in the next one.